Investing at all-time high means different things for different people. Young people might feel very happy and they might just, see the appreciation, take the money out and go about spending it. It's a completely different story for somebody in retirement or about to retire.
Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, the markets have soared, and such times are typically difficult for investors because they are faced with the difficulty of separating the good from the bad. Also, it becomes difficult for them to decide as to what they should do. At such a time, should they invest more, rebalance asset allocation, or they should just, book profit? So in today's episode, we'll give you the equity plan for investors in different phases of their lives. For youngsters, new parents, for those who are about to retire, and for retirees. I'm sure you don't want to miss this. Stay tuned.
Ideally, everyone should invest in equity by way of SIP, spreading your investments over time, investing regularly. But many a times you end up with some lump sum and you are tempted to invest, and it's very difficult not to invest because the market is going up every day. We are in a state of excitement when the market is at an all-time high. And that makes it all the more important that you should not invest lump sum, and which means that you should spread your investment over time. And that is the only way you will be reducing the risk of catching a market high. Catching a market high is devastating because the act of investment in equity is a very optimistic step. You are thinking of maximizing your return, feeling happy about it, and it actually becomes real. The moment you invest, every day the market is going up, and soon thereafter the likelihood of market correcting soon after you have invested is very high. And also, bringing a process or bringing a method to your investment or the way you invest is very important to develop a belief in it. So spread your investment over time. Always do SIP. Don't invest at one go. Don't invest lump sum. Now, how should you spread your investment? Assuming you have 5 lakh rupees, what you should do now? I would say it entirely depends on what is it in relation to your income levels, how important that money is. Assuming this 5 lakh rupee is result of some, is proceeds from a small flat that you had, then I think it is a very critical, and if it's a critical money, then I think you should spread it over next 1 year, 1.5 year, 2 year. If this happens to be your sales incentive, if you got a bonus and it has taken you 2-3 months, then maybe this is the money which you should spread over the next 6 months to 1 year, simply because this is in your scheme of things how important it is. My general rule is that spread your investments in half as much time as it has taken to earn you, but the maximum time frame of spreading your investment should not exceed 3 years. Young or old, every investor should start conservatively, and more so if you are starting out. So start with a conservative vehicle. Even if you are investing for many years, 2 rules to follow always is your first investment should start with an aggressive hybrid fund, even if you are investing for many years. And don't invest lump sum. This should be a non-negotiable rule to be followed by any investor starting out to be on a path of confident investing for a lifetime. Though most young investors will be tempted to invest in a small cap or mid cap, and it might look very attractive, or you are missing an opportunity, or it's a missed opportunity because the vehicle which I am referring to, it may not be going ballistic. But it's very important to, in your initial years, to develop a belief in the market investing mechanism. If you are approaching a goal and you have accumulated some savings and it has appreciated, and right now the appreciation looks even more handsome, what you should be doing is 1 to 3 years before you need the money, you should start preparing for it. Reason is that you can't wait for the last moment. So whatever be your age, before you need the money, start preparing for it at least 1 to 3 years before. In fact, it is not the equity strategy that you have to plan for as you approach retirement. You have to really work on your asset allocation strategy, because you can be in all equity while you are earning. You can well be in 100% into equity if you are in earning years, because you get your salary and you get your income every month, and then you are able to save from that and keep investing. Only when you depend on your income stops from work, that is when you depend on investments, and that is when you should turn little conservative. How conservative, it entirely depends on the scale of your retirement accumulation. So whether you be 20% into fixed income or 35% into fixed income or half into fixed income, it entirely depends on the scale of your investment. And most people think that as you retire, you should be out of equity. That is not true. In fact, it is very important that you should have meaningful exposure to equity to ensure that you are able to protect the worth of your value of your capital. So, depending on the scale of investment, depending on your income requirement, decide on this factor. How much of your money should be into fixed income, and 2-3 years before that, start moving that money into fixed income so that your overall portfolio, all your investments, they become relatively more stable as compared to an all equity portfolio. It is very important to have some allocation, some meaningful allocation to equity, so that at least your capital is able to protect its value. It is able to appreciate at least in line with inflation, and that you need to plan very carefully. Based on your planning, you have to decide that whether you should have 10%, 20% or 30%, 40% into equity. Because if you keep consuming all the return or all the interest generated from your fixed income investment, your capital will remain constant. And if it remains constant, then 5 years down the line, it will not be able to support your income requirement. Decide on that allocation. What percentage of your total money should be into equity, and spread that investment at least over a period of 3 years. It is extremely important to eliminate the possibility of catching a market high, more so in your retirement, because if you invest 30 lakh rupee at one go, and tomorrow the market crashes by 10-15%, which is very routine, which is very normal, which is usual, then you will not be able to bear the shock of losing 15% of 30 lakh in this phase of your life.
Well, that's all we have for you in this episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.